What's up, guys? It's Mr. Fit to Flourish, and today I wanted to talk about all the little nuances that you should know before trading any options, buying any option contracts, or anything. First, we're going to start off right into it. What is an option? An option is a legally binding contract between two parties, and it gives you the right, but not the obligation, to sell or buy an asset at a specific price at a future date. What the heck does this mean? All right, you trade stocks, you know how to trade, you know how to buy and sell stocks, right? Options are the derivative. So they're like insurance on a stock. Okay, so it gives you the right to buy a stock or to sell a stock at a future date. If even if the stock price is moving, it's like buying insurance, okay, to cover your booty. Okay, and it acts as leverage. Essentially, buying and selling stocks is like pretty much betting. And that's why people love it. It's kind of like going to Vegas every single day. And a lot of people are losing a ton of money doing this, but um, including me back in the past was losing hella money. But if you get good at this, then you can really, really leverage a little amount of money and turn it into a lot extremely quickly. Okay. And all you're doing is you're betting on the direction of a stock. And a stock can only go two ways, it can go up or it can go down. It's the only way a stock can go. Sometimes it doesn't move. That's when you don't trade. But essentially, betting a stock is going to go up is buying calls. Betting a stock is going to go down is buying puts. So you can make money when the stock goes up and when the stock goes down. And that's something a lot of people don't understand. And that's what buying options, why it is so lucrative. Okay. And in this video, I'm only going to talk about buying option contracts, so longing calls or longing puts. We're not going to talk about contract writing or advanced strategies. Just keep it really, really simple, and we can talk about those in a later video. But let's get right into it. So pretty much there's puts and there's calls. Puts is betting a stock is going down. Calls, you're basically betting that the stock is going up. Okay. And what I look for, we're going to talk about a couple. Actually, we're going to talk about a couple concepts, and we're going to talk about what I look for in stocks. But one concept that you should understand that a lot of people don't talk about is the Greeks. Okay, well, some people are like, "Oh, the Greeks," but delta. What is delta? Delta is an amount that is shown in terms of your Greeks. It's what makes up the option price. Okay, so the Greeks are what make up the option price that goes into the formula. Delta tells you how much your option will gain, your contract will gain for every dollar move that the underlying, so every dollar move that the stock makes. It tells you how much your contract will gain, how much it will go up by. Okay. So if your contract, you buy it for $100 and your delta is zero point 0.3 or $30, then every time the stock goes up by $1, your contract will go up by $30. So if it's $100, it'll go 130 and 160. Okay. And there's something called Vega that is the rate of change of your delta. So instead of going up by 130 and then 160 and then 190, it's like 130 and then 135, or I mean 130 and then 165, and then 210. So like it influences the rate of change of delta is what Vega does. Anyways, delta and theta are going to be your two most important Greeks. So like I said, delta tells you how much your option contract goes up by. Theta tells you how much your option contract, how much value it will lose for every day that passes. So theta is very important to pay attention to if you like to hold on to option contracts for more than a day, aka swing trading. One thing that I pay attention to with my option contracts are the delta to contract price ratio. So if my contract is $100 and my delta is $30, that means that for every dollar move that the stock makes, I'm automatically going to make 30%. So it's an intrinsic 30% gain. But some people might be buying contracts that are like $700, and then the delta is like zero point 0.1, which is $10. So for every dollar move, your contract is going to go from $700 to $710, then $720. That's not moving the needle. We need to move the needle when we're trading options, and you need to understand what is my delta to contract price ratio? So I'm usually looking for pretty cheap options, which you can find with 1 day to expiration options on SPY, on QQQ. Amazon has really good price options. I'm giving you gems here. AMD has really good price options, low price options. Microsoft, Apple, very good price options with high volume. And that's another thing. Brings me to another point. When you're trading options, you want to make sure that there is volume. Okay. You want to make sure that your strike price, that your option contract you're looking at has volume. Typically, you want that volume to be over 1,000, 2,000, but the bare minimum is a volume of 500. Okay. We can make something happen. We can make something happen. Another concept besides delta, theta, volume is your IV. When trading options, you want your IV to be less than 50%. Always be looking at your option IV. What is IV? It's implied volatility. So it tells you how much your option contract can fluctuate. Now, if your IV is over 50%, then on a day to day basis, if you're going to be swinging your option contract, holding it overnight, then overnight, your contract, if you buy it for 500, well, it can go to like 200 or $90 if your IV is way up there. So we see this a lot during earnings. During earnings season, a stock might have earnings upcoming, and the implied volatility, the IV, is usually up over 100%. It's like 120%. Okay, so you might buy a contract and it might be $500, and then the next day, earnings happened and the stock didn't really move, but the option contract did, and that $500 went to $50 because the implied volatility, the volatility of that option contract was so high. So pay attention to IV. You want it to be less than 50%. If you're swinging, if you're just day trading or getting in and out of a trade really quickly, it's not as important. But you do want to make sure that you're trading option contracts with an IV less than 50%. Okay. And when I'm talking about these option contracts that we're buying, we're talking about calls, we're talking about puts. I'm typically I'm looking at all the time. I'm looking at out of the money contracts. What is out of the money? Well, it's the price that we haven't reached yet. So if we're getting calls, we're betting the stock is going to go up, right? So let's say my stock price is currently at 100. My strike price, I'm going to aim for like 105, but I'm going to go 2 to 3 strike prices out of the money. If I'm getting calls, that'll be like, oh, okay, we're at $100, which is at the money. $100 is where the stock price is at. And then 101 would be the next strike, 102, 103. I would get something like 102 or 103 strike price. Why? Because out of the money contracts fluctuate more, which means like I can get fluctuate more in the positive direction, have a bigger delta to contract price ratios. So they're usually cheaper, and their deltas affect them a lot more. So as we get closer to them, then they start moving up in price really quickly. We start making a lot of money really quickly. Okay, you get the better bang for your buck with out of the money option contracts. And you don't want to go too far out of the money. Like you don't want to go way far out. When you're choosing an out of the money strike price, you want to make sure you're paying attention to the average daily range that your stock makes. How quick and how much does your stock typically move? Then you can kind of think like, okay, well, I think we can at least make 3 points to the upside and get pretty close to the strike price. We don't have to hit the strike price. We just have to be moving towards the strike price in order to make money. And how much money are we going to make? Well, whatever my delta is going to tell me how much my contract price is going to increase for every dollar that the stock moves. Okay? Huge concept to understand. Another concept to understand about out of the money options is that they have no intrinsic value. So like all the prices are freaking honestly made up. They're just made up prices because they're insurance. They only have extrinsic value. Now, what makes up the extrinsic value in option contracts? Well, it's going to be the time value because you're given time for the stock to get to that price. So your bet has time. You're paying more for time. So whenever you have option contracts that you're picking like 2 weeks out, 4 weeks out, 5 weeks out, they're going to be more expensive because that time portion, you're paying for the time to allow the stock to get to that level that you're betting. Okay. And then aside from the time value is the volatility. So time and volatility are the two extrinsic factors in an out of the money contract. So there's no intrinsic value. Okay. There's no underlying value. It's just volatility and time. That's all you're paying for in out of the money contracts. So if they expire worthless. Now in the money contracts can be traded in for actual shares. So they have intrinsic stock or the difference between and it gets pretty complicated. It gets pretty complicated. So we're not going to talk about that. Okay. Because I can explain it and then you're just going to be more lost. Whatever. Anyways, anyways, so these are huge concepts to understand. Another concept to understand is the VIX volatility index, so that you can track it. And this week was the week of August 5th, August 5th to the 9th, and it was pretty much like a Black Monday again. Stocks fell out of the sky. The volatility index went up to 60, which is the highest that it's ever been since 2020 COVID. So it went up to 60, which caused which causes a huge increase in option prices. Huge increase, and the option prices don't make sense, and they're not tradable at that point. So if the volatility index is going up, your option contracts are going to be extremely volatile, and the prices aren't going to be fair prices. Keep that in mind. Last but not least, I wanted to leave with one thing mentioning zero DTE. You might see zero DTE all the time. Zero D like dog, T like Tom, E like Edward. Zero DTE. You might see this term all the time. You're like, what the heck is a zero DTE? A zero DTE is 0 days to expiration. 0 days to expiration. So what does that mean? It's a contract that expires the same day. People like to trade these contracts because they fluctuate extremely quickly, and you can go from having a $50 contract and it can go to $500 in a matter of seconds. It is extremely volatile. Extremely volatile. Okay. And that $50 can go to zero in 1 second. It can go to zero quickly. Or you can buy a $1,000 contract and it could go to zero in a matter of minutes. So 0 day to expiration contracts expire the same day, but as prices fluctuate on the underlying asset on the stock, that contract price fluctuates way more dramatically than usual for option contracts that have time, like days until they expire. This expires same day. So remember what we said about the value, the extrinsic value of an option. It's especially for out of the money options. The only value in them, and most people get out of the money options with zero DTE. The only value is time and volatility. Well, if there's 0 days left to expiration, then you don't have time. So all you have is volatility. People don't understand this. It's pretty simple. So that's why your 0 day to expiration contracts are extremely volatile. And if you don't understand options or the Greeks, if you never knew any of the stuff I mentioned and you're trading 0 DTE, that's kind of scary. You should not be trading 0 DTE options. The only time to trade 0 DTE options is when there is directionality, when there is a trending day, a trending stock, or trending market. So when there's a ton of momentum in one direction and it's extremely clear, that's when you get in and you get out, and you get out really quick. You get out really quick. Okay. One of the people that I follow closely, I consider a mentor, indirect mentor, is Steven, and he is a former, like, former CEO, exec type person in a major company, major hedge fund, major company. Okay, and he always says, "Jack be nimble, Jack be quick, don't get caught in a candlestick." And this is really funny because people get caught in these zero DTE candlesticks. Okay, because they don't understand options and how they work. So don't be one of those people that get caught in zero DTE. Don't trade zero DTE if you don't have a setup, especially if you're a beginner, if you don't understand how options move, And last but not least, if it's not a trending day, if there's just Wick City, Wicks, sideways consolidation, pullback consolidation, you're getting crushed. Because remember, there is no time value. There's only volatility. Okay, there's only volatility. So, the last thing I wanted to say too was for understanding where option prices will go towards the end of the week to know where stock prices will land, you can go to maximum-pain.com. Maximum-pain.com. And it kind of tells you where market makers want the option or want the stock price to fall by following how many calls and puts are written during the week and where they want the stock price to fall. So just wanted to leave you with that gem. It's Mr. Fit to Flourish. I just caught a cramp a couple seconds ago. You saw me like jump. I just caught a cramp. I've been working out too much. The Fit to Flourish part is going crazy. Working out too much. But I'm gonna get out of here and stretch. Hope you guys learned a lot in this options video. You guys have a great day, great weekend. It is August 10th. Have a great weekend. Enjoy, and I'll see you on the next video. Peace.